Welcome, everyone, to our session on sensitivity analysis and capital budgeting. My name is Cameron Burrell, and I'm excited to guide you through how sensitivity analysis helps integrate risk into investment decisions. This presentation is designed for our MBA Business Class 604 and will explore both quantitative and qualitative factors that influence capital budgeting decisions. The primary goal of financial management is to maximize shareholder wealth and long-term enterprise value. To achieve this, managers plan, organize, direct, and control financial resources effectively. Financial management strategies like hedging, diversification, and insurance safeguard the firm against unexpected losses. Finally, aligning financial goals with broader strategic objectives and maintaining healthy cash flow ensures that investments support the overall vision of the organization. Capital budgeting evaluates long term investments using methods such as net present value, internal rate of return, and the payback period. Net present value discounts future cash flows at a rate that reflects financing costs and risk. Higher discount rates signal higher risk, which reduces the present value of those cash flows. The payback period is useful for gauging liquidity but overlooks the time value of money and risk considerations. For a comprehensive evaluation, firms should combine multiple measures to capture both profitability and risk. Sensitivity analysis helps identify and test key variables like sales, cost, and discount rates that drive a project's performance. You begin by defining plausible ranges for each variable, then vary one factor at a time to see how outcomes change. Plotting the results using tornado diagrams or line charts help visualize the impact. For combined changes, multi-way sensitivity analysis or Monte Carlo simulation can be used. Finally, compare findings to scenario analysis, which changes multiple variables simultaneously to get a fuller picture of risk. Several quantitative methods help integrate risk into capital budgeting. First is the risk adjusted discount rate or radar, which equals the risk free rate plus beta times the market premium. This adjusts the discount rate for the project's risk profile. Net present value and internal rate of return should be computed using the radar. Monte Carlo simulation generates a distribution of outcomes by randomizing key variables, offering insight into potential extremes. Decision trees and real options model sequential decisions, capturing flexibility in investment timing or abandonment. Scenario and stress testing examine best case, worst case, and most likely outcomes to inform contingency planning. Besides the numbers, qualitative factors play a crucial role in capital budgeting. Projects should be evaluated for their environmental impact and sustainability commitments. Social responsibility and ethical considerations influence public perception and regulatory standing. Brand reputation and customer perception can enhance or erode long-term value. Employee morale, company culture, and talent retention affect productivity and innovation. Finally, regulatory compliance and strong governance ensure that projects meet legal standards and build stakeholder trust. Risk in capital budgeting comes from both internal and external sources. Internal risks include operational and technical failures, cost overruns and delays, financing constraints, and governance weaknesses. External risks stem from market volatility, such as price, interest, and currency fluctuations, plus regulatory or legal changes, macroeconomic shocks, and technological obsolescence. To mitigate these risks, firms should diversify investments, use hedging and insurance, create contingency plans, and maintain robust governance and risk budgeting frameworks. A structured approach helps integrate risk into capital budgeting decisions. First, identify risk by engaging stakeholders and compiling a comprehensive list of internal and external threats. Then quantify these risks using sensitivity analysis, scenario analysis, Monte Carlo simulations, and decision tree methods. Next, evaluate the findings by incorporating qualitative factors and using risk adjusted discount rates. Finally, decide and mitigate by ranking projects using risk adjusted net present value and selecting appropriate mitigation strategies, such as diversification, hedging, or redesigning the project structure to manage the identified risk. Here is a list of references that we used in our research in putting this presentation together. I ask everyone to take a look at it. And also, I want to say thank you and I hope you enjoyed the presentation. Enjoy the rest of your day.